Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Madan Sabnavis, Chief Economist at Bank of Baroda, joining in. Welcome to the show, Madan, and always a pleasure to speak to you as well. Madan, let's start with the global context first and then come down to what's happening in India. Across in terms of Europe as well as US, we're talking of, a recession hitting. Inflation, as we know, is a major concern, because of which you have majority of the central banks who are looking at squeezing out the liquidity, increasing rates, etc. How are you viewing the global scenario?
Yeah, as you mentioned, I think there are fears of a recession in the West. And this has primarily been caused on account of the tightening of interest rates, which central banks have started, especially the Federal Reserve. And the ECB is also expected to follow suit. And we have seen even other central banks, like the Bank of England, also doing so. So one should remember that inherently, when we start increasing interest rates and you have a very aggressive monetary policy, it does tend to slow down the economy. So what we saw, the kind of rapid pace of growth in the US, which was manifested more in terms of how the unemployment rates has fallen to an all-time low, I think that is an indication that the economy was doing very well. And the Federal Reserve, as the monetary authority, did take the stance that since inflation was increasing in the region of around over 8%, I think it was necessary to tighten the belt, and that's when we have seen the interest rates increase, rolling back off the easy liquidity which was there earlier, something which also the ECB is contemplating. So all this means that there is going to be a slowdown from the demand side, and that is something which is going to get reflected in terms of slower growth in the global economy this year.
Right. So Madan, overall, if you see, when you're saying that there will be a slowdown in global economies, what's the direct impact are you envisioning in terms of emerging economies like India?
So the first impact will be that there would be a tendency for global commodity prices to soften. So I think that is something which has been affecting all countries, and there could be some solace in the fact that if the global economy continues to slow down, commodity prices will come down. We already saw that commodity prices have started softening. If I keep out crude oil, we have seen prices softening in the months of May and June, and probably this will continue and provide a lot of comfort to central banks across the world. So that's how the emerging markets will see the positive benefit. Second, in case one is an export-oriented economy, there would be challenges because America and Europe are two geographies which provide a lot of impetus to other countries which are export-driven. India, to my mind, will not be affected that much because most of our exports, while they are driven by global demand conditions, but being more traditional in nature, may not see that kind of volatility which maybe the other East Asian countries would be facing. And the other thing would, of course, be an interesting point where I'm not quite sure which direction it will move, would be the foreign investment flows. Because we have seen that foreign investment normally has been very volatile, particularly in the last couple of years. And that is something which could be driven either ways on account of a recession. Because if there are not too many growth opportunities in the West, they should ideally be hunting for better opportunities in the emerging markets. And that could be a kind of a benefit coming there. On the other hand, one could also say that in case conditions are down, there may not be that kind of an investable surplus, given the fact that the QEs, which we saw in other countries, are now narrowing down. So therefore, that will be a kind of an unknown. But to my mind, the tilt would be more towards withdrawal rather than higher investments coming through. But it could go either ways. So I think that would be the general impact in terms of a recession on the emerging markets.
Right. And overall with this, as you mentioned as well, we will see easing of global commodity prices, especially what's happening in terms of crude right now. That's clearly adding some bit of optimism. So how are you viewing the inflation print to look like in terms of FY23? What's that average that we're looking at? And is there a scenario where probably the months of August, September could see a peak to even levels of around, say, 7.75 to an 8%?
I think the base effect, which was favorable in the past, will probably continue for the month of June. Subsequently, there will be a tendency for the inflation rates to increase. Now, while we're looking at an average of around 6.5% for the year, we do not really think that prices are going to come down anytime soon, because we're seeing problems, especially on the manufactured as well as the services sector, where prices are in the process of being increased. We've seen that in Q3 and Q4 of last year, a number of manufacturing companies have increased their final prices because a part of the raw material costs which went up have been transferred to the consumer. We've seen a second round of price increases which have happened globally until say March or April. And this is something which companies will have to take a decision whether at this particular point of time do you increase your prices further or not. We've seen this happening in the FMCG sector, which also includes your food products. And things like prices of wheat, even for edible oils, notwithstanding the fact that duties have been cut, we have still seen that the prices have not really come down to the same extent. So while I continue to pay around 200 rupees per liter of edible oil, we're not going to go back towards the 130, 140, which was the situation before the prices increased. So therefore, I would tend to believe that even if I keep crude oil aside, because we really don't know if crude oil prices will ever revert to the number of $80 per barrel, to my mind, it will remain in the region of around 100 on an average basis for the entire year, even in the best of conditions. I would tend to believe that prices would continue to remain in the move in the upward direction. There could be some solace coming in case we have a good monsoon and a very good crop. The picture doesn't look too healthy right now. If I look at the swing pattern, we're not quite sure what will happen in the coming months, because admittedly, I think July and August are the critical months for the Kharif crop. But even so, if we have a good crop, given the fact that our MSPs have been increased, and even in terms of the farmers' cost of living has gone up, there would be an inherent tendency for prices to increase, even in case I do have a very good harvest. And it's always a case of saying that there's equalization of prices which takes place, even very innocuously, even if you're looking at something like edible oil, not edible oils, I would say for the seeds. If I look at, say, soybean seed, you're looking at mustard seed, there would be a tendency for equalization to take place if international prices remain at higher levels. So while they have come down, but they've definitely not gone back to the levels of pre-pandemic. So therefore, there would be an inherent tendency, even for food prices, to remain on the higher side. So that's why I think inflation will be fairly stubborn for the rest of the year.
Right. And taking that inflation number into consideration, in consonance to that, how are you viewing growth? Because if you see in terms of the FY22 performance of corporates as well, it's a good growth that has come in, right? With that, again, we're looking at double-digit credit growth in terms of, the overall economy. And majority of it, we're saying that probably it's the corporates which would start contributing to it as well. So how would you link that entire growth, corporates to credit growth kind of a chain?
If we look at the way in which we look at growth in this year, given the fact that we've had 1 year which was a washout because of the lockdown, some kind of recovery which took place last year, I think there will be a continuation of that growth process this year, but not to the same magnitude. So we're looking at something in the region of around 7.2% of GDP growth for this particular year. Now, how is this growth going to come back? Because of the inherent size of the economy, the nature of the economy, the fact that certain jobs have been created. There's a major pent-up demand which has led to a revival of a number of industries, especially in the services sector. And given the fact that India is a services-oriented economy, there would be a tendency for demand to pick up. Now, where I find could be a problem would be that if inflation remains at a level of, say, 7.5% in the next few months, which is possible, then there is a case of saying that during the festival season, post-harvest season, the kind of a consumption revival which we normally bank upon will not really materialize to the full extent. So there could be a downside to the growth in case the consumption side story doesn't really pick up. In terms of investment, I think while the central government will continue on its capex plans, we're not sure of what happens to the state governments. But in terms of private investment, I would expect investment to pick up, but it will not be broad-based. It will be restricted more towards the sectors which are geared towards the creation of infrastructure. So if I look at consumer-oriented industries, we may not be seeing the same kind of investment taking place. The capacity utilization rates, as reviewed by the RBI, are fairly encouraging, but I think I would be a bit more cautious in terms of interpreting this, or rather extrapolating it towards investment. It would be very much restricted to sectors like maybe steel, cement, certain extent chemicals, but definitely not towards things like pharma or even the consumer-oriented industries, both durables as well as non-durables.
Right. And overall, when we spoke about the FPI inflows as well, we have recently the RBI who's gone ahead and taken measures such as easing of rules of FPIs, especially in terms of where the domestic bond market goes. Now, do you think that's something which will help us elevate the funds in terms of foreign investments coming in, number one? And two, how big is that number, expected to be? Because that's something which will then help us strengthen our balance of payments as well, and needs to be higher to the current account deficit.
No, I'm not too sanguine out here because the corporate bond market has not been a favorite destination for FPIs even in the past. So we've had these limits which have been given. They've hardly been utilized, maybe 20, 30% at the best of times. And that's because of the intrinsic nature of the corporate bond market, which has not really evolved in the absence of secondary market. And we don't have too much of paper which is floating around. I think that's also another issue. So therefore, I think while the RBI is opening up, allowing more FPIs to come in, giving them more leeway, is a positive from the point of view of policy. But in terms of actual numbers, I don't think it'll be very significant. It'll definitely not be able to turn the tide, change a negative to a positive. Maybe a little bit could come in at a margin, but I don't think that's going to make a material difference to our overall balance of payments, or even for a matter for FPI inflows, which should continue to remain in a negative zone.
Right. And overall, how are you seeing the fiscal deficit side of it? Do you think the numbers that we're looking at is absolutely on track? Or what are the estimates looking like at your end?
No, I think generally the government does manage it because there are ways to cut down on certain expenses in case that contingency arises. And the positive part is so far, I think the news on the fiscal side is very good because probably because of the high inflation numbers, we are seeing that your tax collections have been very, very buoyant. And we may not be having the same kind of problems which the states had in terms of compensation in the last couple of years. So I think the revenue side seems to be quite buoyant as of today. But of course, when we're talking of 3 months, we're not quite sure what will happen in the rest of the 9 months. But given the fact that conditions are not going to deteriorate any further, I think the government may not have too much of problems in terms of managing your fiscal deficit. There's of course an issue of saying that, will I still get my disinvestment proceeds? I think LIC has helped a lot. That's one. I'm not quite sure how the accounting is done, whether it's been taken for this year, last year, whether the numbers have been revised or not. Second, there's also that question of the additional expenditures which have been incurred on account of fertilizer as well as the food subsidy which has been given by the government. These are things which could probably put some kind of a pressure on the fiscal numbers. But at the end of the day, I think given the buoyancy which we're seeing in the tax revenue, there may not be too much of a slippage which you're talking about. We could probably still just manage that number at 6.4%, maybe 0.1, 0.2% could be the kind of deviation at the end of the day. With that, the GDP, nominal GDP growth is still going to be quite buoyant, probably because of the inflation number.
Right. And overall, Madan, if you see in terms of the bond deals and the way rupee is moving, what's the sense that you pick up on those two fronts?
See, I think the bond yields are going to inch upwards, but it's all going to happen periodically. When I say periodically, every policy measure is going to add to the bond yields. So if I look at a 10-year bond, which is going at around 7.4, it's gone to 7.3, 7.5, it keeps vacillating. I think it's going to move in the upward direction, probably towards the 7.75, 8% mark by the end of the year. The reason being that we do expect that the repo rate will still be increased 50 to 75 basis points during the course of the year. It may not be as aggressive of what it was last time, but it will be more calibrated as 25 basis points at a time, because this inflation number is going to remain generally above the 6% mark, at least for the next 6 months.
Right. And what's the counter impact that you're seeing in terms of the Indian rupee?
See, in terms of the Indian rupee, I think we're doing fairly well, I would say, because while this continuous depreciation has been a worry, I would look at what is happening to comparable currencies, and given the fact that the dollar euro parity is almost being reached, I think that's the global influence which has actually overwhelmed even the fundamentals. Of course, even in terms of fundamentals, our forex reserves are going down, which means that there's more demand given the supply of compared to the supply of dollars, and that kind of a scenario will continue with a trade deficit widening, the current account deficit widening, FPIs being negative. So there will be pressures even on the fundamental side. But the way the rupee is going and the way in which the RBI is trying to manage it, I think there will not be any sharp depreciation. What we have noticed is that if I look at comparable currencies and say that the rupee depreciation, how does it stand? We are probably at a median level. I don't know if that's something which the RBI has worked at or whether it's just turned out to be that way. But I think the rupee will continue to depreciate, no sharp depreciation. Maybe we'll have to take it at 50 paise or 1 rupee at a time. So currently one will say 79 to 80 looks the near-term outlook for the rupee. And I'm sure once we reach 80, because it's always been a gradual movement towards these benchmarks, we could probably talk of something beyond 80, maybe towards 81. But right now, I think I would stick my neck out and say 79, 80 looks to be the thing, at least for the next couple of months.
Right, so 79 to 80 for the next couple of months, but moving to 80 to 81 probably from a medium to long-term perspective is something that can be expected.
Yeah, absolutely. And I think that's something which the RBI should also allow, because even though I'm not a great believer in rupee depreciation helping in exports, but to make sure that we don't lose the competitive advantage just to maintain our exports, I think this kind of a depreciation is required because it's happening across the world. And this is something which I think whenever we're talking of exports, anything to do with trade, I think we have to look at the global environment also, what's happening to other currencies. So therefore, I think even 80 to 81 may not be a real bad number.
Right. And Madan, very lastly, any key important points that you think one needs to consider, from a lens, to view the economy, what we would have missed probably?
No, I think one has to live with this uncertainty, because I think we're not really certain about how the markets are going to move, how crude oil price is going to move. I think to begin with, it's the crude oil price, how central banks are going to react, whether how seriously do they take the developments which we're seeing, especially on the inflationary side. So I think this is something which we need to, which are unknowns, which is something which we need to keep an eye on, because that would actually provide some kind of clue about what could be happening in future. Because as of today, I think there are lots of uncertainties, and there's a lot of guesswork which is going on. Crude oil was at 110. We never thought it would go up. It went to 120. Then again, we were talking about 150. Then it came less to 100. But today, again, we're saying it will be probably between 100 110. So I think that's been the main pivot over which a lot of uncertainty arises. Because I think the moment the inflation issue is addressed, there will be definitely a lot of more solace for central banks across the world, and even in terms of overall flow of funds. So that's the way I think we should be looking at it. Cautiously look at all the numbers which are coming through, and really not taking long-term calls, because we're not going to get them right anymore.
Absolutely. So I think a lot of things that we need to wait and watch and see how all of that gets stitched together, because that's when we will be able to see actually what the roadmap looks like. But thank you, Madan, so much for joining us on the show. It's always a pleasure to speak to you. Thank you. Stay safe and speak to you soon again.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.